are here. Let's see if we can. Okay, can you hear me okay, Antonio?
I can.
Loud and clear. All right. So today we're talking about.
Today we are talking about home loans. No, just playing. Refinances. We want to talk about some refinances.
Today we're talking about why it's the perfect time to purchase a home, right?
That's always the conversation.
That's always the conversation. But we're talking about refinancing today, right?
So yeah, let's talk about if you already own a home, it's the perfect time to refinance that house and buy a new one.
There you go. There you go.
Let me grab some juice here.
Okay.
All right.
All right.
So
Antonio, listen for 1 second.
Sure.
Because like I said, I'm getting a refrigerator delivered today. And of course they would have to come now. So I'm gonna let you go ahead and start off, and then I'm coming back on, okay?
Okay, I'll be here.
Right.
So while Miss Jones takes a quick break, I don't always say Miss Jones because of that song, but it's Mrs. Jones. I think the song is Mrs. Jones too, now that I think about it. But anyhow, today we have a conversation about refinancing. What is a refinance? Or all the different reasons that you might want to refinance. And also, what our refinance rates look like compared to like a regular purchase rate, because there's a difference when you do one or the other. But the basic definition of a refinance is take your existing mortgage, your existing debt obligation, and just put a new loan on it. The major benefit of that is also the major setback. So the major benefit is you get to start over on a new 30-year term. And what that does for you is basically stretch out your existing loan for a longer period of time, which is going to lower the payment. The setback or the downside to that is you just started your mortgage over 30 years, right? So you're paying on your mortgage for 5, 10, 15 years, and then you refinance, and now it's back at 30 years. So it's going to take you longer to actually pay off that home. That's just a broad scope of refinancing after you've already been in your mortgage for a period of time. Now, there are tons of benefits to refinancing. And I think from some of our past conversations for the past couple of weeks, one of the major benefits is when you have enough equity that if you have a loan that has mortgage insurance, if that's an FHA loan with PMI, or if you have a conventional mortgage and you never put down that 20%, well, once that equity has appreciated and is now present in your home, now you can refinance into a mortgage and get rid of the PMI payment, the PMI portion of your payment. Now, an FHA loan comes with PMI regardless of how much equity you have. It will change. It will be factored differently if you have equity, but it's still there. So you might actually want to refinance out of the FHA loan altogether. Mrs. Jones is back. So I was just breaking down the broad scope of refinance, the pros and cons. And from a broad scope is you get to stretch your loan back out, right? Take your existing payment. If you refinance, you start over on 30 years. So that should lower your payment. But that's also, a setback in some sense, because now here you are, you're starting over on this 30-year process once again. So, the immediate need or cause to do that would be to eliminate that mortgage insurance. A few years into being in the house, you should have some equity. You might be able to get out of that PMI, get out of an FHA loan altogether. So those are some reasons that you might want to get out of there. We talked before about how an adjustable rate mortgage can sometimes secure you a lower rate going into the home than a fixed rate mortgage, but those adjustables are typically fixed for a period of time, 3 years, 5, 7, or 10. Well, then at that 3 year, 5 year, 7 year mark, that could be a reason that you might want to go ahead and refinance now, because you don't want to see the adjustment cycles kick in. So now you would jump into your regular 30-year fixed or even a 15-year fix, depending on where your payment is. So those are some of the reasons why you might want to refinance. The different types of refinances are pretty basic. It's a rate and term refi. So you're just taking your existing balance, putting it on a new loan, new rate, new term. And then there's your cash out refinance, which means I've got a lot of equity and I want some of it in cash. I want it in my hand. I want to be able to use it, and then I'll just go ahead and finance that number as a new loan. That's a refinance, and that's different than an equity line. You do an equity line also, where you just tap into that equity without messing with the original 30-year mortgage.
So can you kind of break that? I mean, and I know we're talking about refinancing. So, well, let's go here first. Let's talk about, and I hate I had to jump off for a second, and I hope you didn't go over this. But when it comes to when it comes to refinancing, so if a person has been in their house, okay, let's start here. How long would they have to be in their home before they can refinance?
Well, the real answer is 1 day.
Okay.
That's the real answer.
Okay.
However, that's for like a certain scenario. And that scenario is like delayed financing. So let's say I sold my house for cash, right? I got a bunch of money and I see a house and I want it now. Or I got a bridge loan, whatever. But I see a house and I want it now and I want to buy it now without worrying about the financing. Man, I don't like rates, whatever the reason is. I can buy that house now and then turn right around and do what's called the delayed financing and go ahead and now do the mortgage, get my money back in my hands, and then just finance my mortgage. So the real answer is immediately.
Okay.
But typically speaking, you're going to need to make 6 mortgage payments on a loan before the lender wants you to refinance. Okay. And there's reasons for that. A lot of it has to do with regulations on, how the broker or loan officer is paid, credits given to you at close. And so all of those things are done with the assumption or the presumption that you're not going to refinance for at least 7 months, which equals 6 payments. Your first month in, you don't make that mortgage payment. So 6 months is generally when you're allowed to refinance.
Okay, 6 months. And then when it comes to, if I was to come to you and I went through you to purchase my home, which I don't have to go through you to purchase to refinance, correct?
No, so you can use a different lender. You don't have to go back to the same bank. Right. There's benefits. We can talk about that in a minute. So no, you bought a home with XYZ and then you want to refinance and you stumble across a new lender or you see an advertisement for a rate and you're like, oh, I want to call that guy and get a refi. That's perfectly fine.
Okay, so I've made payments for 7 months now, or I've been in my home for 7 months, been on time with all my payments and everything. What would I need to bring to you in order to refinance? What would I need?
So it's going to be almost like qualifying for the original loan. And depending on what loan program you're in, we can get away with little to no documentation. So let's touch that first.
Okay.
If you're in an FHA loan, we could do what's called a streamline. A streamline FHA means I'm going to take the balance that I currently owe. I'm not going to add anything to it, but I just want that better rate, right? I bought my home 6 months ago, 7 months ago, and rates were 6.5%. My friend has an FHA loan and his or hers is only 5.5%. I want that. Cool, you can have that. It's an FHA streamline. You basically, no income documentation. You really just fill out an application with your property address and your personal contact information, and we can process that through because you're already in the home on an FHA loan. And the argument here is FHA rates have improved, and I want that rate.
Yes.
And so as long as you've made those 6 payments, we can streamline you into the new FHA rate with little to no documentation. Like literally you fill out the loan application. In most cases, they won't even have to do a full-blown appraisal. And that you can close those loans fairly quickly. Okay. The same is possible for someone on a VA loan. Now that's called an IRRRL, right? So it stands for interest rate Interest rate reduction refinance loan. So basically, same thing. I'm on an I'm on a VA loan. Rates were 6% when I got my house. I've been in here for 7 months and I see that VA rates are lower. I want that rate. Little or no documentation, fill out the application, you get put into the brand new VA loan or the brand new rate.
Okay.
The regular conventional home loan, I've been in my house 7 months, I've made 6 payments, I hear that rates are better. What do I need to do to qualify? Pretty much the same thing you need to do to purchase the home. We're going to need you to fill out the application, bring in 2 months paychecks, show me your W-2s for the past 2 years. Might not need an appraisal. Sometimes I do like a desktop appraisal. Now, if there's been a bunch of equity in there, you're trying to show that, then we'll need a new appraisal.
Right.
Basically, in a conventional loan process, you're going to need to show the same stuff you would to make the purchase.
Okay. As far as, say if someone, and I'm thinking of like if someone co-signed for, like if they needed their mom to, and this is longer than 7 months, of course, but say if they needed a help purchasing a home and now they're at a point where they want to take the parent or the sibling or whoever helped them purchase the home and they needed to refinance. Is that considered a refinance, or how is it to take someone's name off of a loan?
Yep, that would be a refi.
Okay.
That would be a refinance.
Okay.
You basically would just fill out the loan application, call it a refinance. There's a checkbox. Is this a purchase or is this a refi? That's a refi. And then now, instead of having borrower A, B, and C, you just have A and B, or just A, right? You took the mother-in-law off, or I mean, let's say, there was a husband, wife, and then there was the mother-in-law or, another family member, and you want to take that person off. Yeah, you just drop them off. You can refinance. Let's say husband and wife are bought the home together and are still occupying the home together, but wife's credit is dramatically better than it was when they purchased, or vice versa. Someone's credit is really good. They got in on a 580 FICO score, blah, blah, blah. Now someone's in the 600, 700 range, and they're making good money, and they can qualify a loan. Then now we can do it in just the wife's name or just the husband's name. And then that's a refinance also. Now, let me just say that title is something different. So I can own the loan, but we can both be on title. So we both own the house for survivorship purposes, but I'm the one on the loan. So that's doable. Yeah.
And I think that's pretty normal too. I know even with, in our household, that's the way we do it. So then no one's like overextended or anything.
Yep,
and you can continue to, to grow and everything like that as far as, financially buying property and all of that good stuff.
Yep.
So trying to think what else can I ask you about this? I mean, because refinancing is pretty cut and dry. I mean, wouldn't you say so? I think a lot of people think it's harder than what it is. I mean, it's pretty simple.
It's pretty simple. And I think, a lot of people get scared to refinance because of rates, like they say, oh, well, rates are higher now, or rates are, I'm waiting for rates to come down. I always hear waiting for rates to come down. At the end of the day, there's just a lot of reasons to refinance. And that's where people's mind need to expand a little bit. So, sometimes when I'm working with a client, I'm just going to use numbers, right? So let's say that their monthly housing expense is $2,500. Okay. Their car notes, $500. A couple of these maxed out credit cards is hurting their credit score, and all the minimum payments together totaling another $300 or $400. So now we're $3,400 in monthly outgoing expense. Now we're talking about budgets as opposed to mortgages alone. So I'm paying $2,500 on my house, $500 on my car, another $300-400 in credit cards, and I can't write off credit card interest. I can't write off the interest on that car note, but I can write off the interest on my home loan.
Mhm.
So my job at that point in time is to analyze everything on the credit and say, well, what if I can get you back into just the $2,500 payment? But now you own the car and all your credit cards have been paid down to zero. And so you can do that? Absolutely. And now you're writing off interest that you couldn't write off before
Right.
because it's all in the home loan. I have a client that I'm working with right now, similar situation where she needed $50,000, $60,000 to do some work on the house, a remodel. She had the money in the bank, but she didn't want to spend 60,000 and then now it's all gone.
Right.
And so I looked at her entire credit report and was able to see they're paying $707 on the car. She's got a few credit cards that are, minimum payments, but they're all on the max out side. And there was a couple little things hanging out that were like past due collections that she didn't even realize existed, like an old Verizon bill. I'm trying to remember what the other one was. I think it was 2 Verizon bills and some other debt that she didn't even realize existed. My thing was to do an income analysis and an outgoing expense analysis and just say, well, here's what I can offer you. And in this particular case, I was able to show her how her payment actually went up $400 a month on her mortgage. Okay. Now, why would that make sense? Why would I want to pay $400 more on my mortgage than I was paying before I spoke with you?
Yep.
Well, because we just paid off your car.
Exactly.
And we freed up $728 a month there. So actually, monthly outgoing, I just saved you $300 a month, and you own that car. We also paid off those other little small debts that I talked about, and so she came out into a much better position. Her credit score was going to increase as soon as those things get cleared up. She's saving $300 and some in cash flow, and here's the cherry on top: we gave her that $60,000 that she needed for the remodel.
Wow.
So she replaced her 60 grand that she was spending on the remodel. She paid off the car and her mortgage payment went up, but she saved on the car note. So she's actually saving $300 or $400 a month. She got $60,000 in cash and paid off her vehicle.
So let's dive deeper in that. So the $60,000 that she got
Yes,
to do some not refinancing, to do some remodeling in the home.
Mm-hmm.
What would you need? So kind of take me through that. So if you say I have my home and I need to do some remodeling, like I need to put in a new bathroom, bathroom and everything, just upgrade. I want to upgrade the kitchen. Let's do that. Upgrade the kitchen. What does that look like? Like, would you have to come in? Would you guys have to come in and do an appraisal to see what other homes in the area look like and what they're appraising for before you gave me the money for it? How does that work?
So no, we would not have to. So a lot of times value in homes are, they're done off of what's called comps, right? Comparable sales. So the mortgage company can easily look at your property and tell what it should be worth based on comparable sales. Okay. Now, they will do a desktop appraisal, so they analyze the data, and they'll do a drive-by appraisal, drive by the house, make sure it's actually still there. There's a physical home on this address, right? So those are some of the ways we can get by needing some sort of full-blown appraisal before you can get that money. Now, depending on the scope of that work, will depend on if we wanted to do something different with your home loan structuring. So we can just do a regular cash out refinance. We don't have to tell them what it's for. To be honest, you don't have to tell the lender what the money is for. There's a box that says cash out other, and we just check cash out other because there's debt consolidation, there's student loans, there's some other reasons you can list, but you can just check box the cash out other, no questions asked. So if I give you $40,000, $60,000, we don't care what you're doing with it. Now, if you
buy a new property,
find another property, which is it's like Monopoly in real life. So you can do whatever you want to with this money. And if you are remodeling your kitchen and you say, well, now that I've remodeled my kitchen, I want the world to know that my house is worth more. Well, for what reason? You want to pay more in property tax? Like, really, let's think about that. Why would you want to disclose that unless you were getting ready to sell your home later? Now, when you get ready to sell your home, the person coming in to buy that house is the one who's going to get the appraisal, and then they'll be told what that house is worth with that kitchen remodel or whatever that remodel was. Now, backing up one step, when would we need an appraisal? Let's say you want to do an extensive remodel. Let's say you want to add a granny flat, add a couple hundred or even 1,000 square feet, or totally redo the kitchen, like tear it down and come in with all these brand new appliances and all that type of stuff. And you want that tied into your existing mortgage. Now we're doing like a remodel. We're doing a rehab, a rehab. What is the word? Refinance. Sorry. Two R's and two Re's in there. So now we're doing a rehab refinance. So the same way you can purchase a home and get the money included to purchase the house and do the rehab, you can refinance a home and get the money to pay off your existing mortgage and the rehab costs in one loan. And now when that closes, it's based off of the after repair value. So now we know what that home is worth after the repairs. And so you can get a lot more money that way.
Okay.
And it's done for a purpose. And people can do that, like, you hold listing appointments. And if you think someone's kitchen is severely dated or home is severely dated, maybe we're on a 6-month plan now. So instead of selling as is, hey, let's rehab this with contractors, right? That's the other part. Let's rehab
with
this
contractors
and get this done, get this work done, add another bathroom. This is stuff that you can do now. You don't have to sell your house as is and walk away from a potential higher listing price. So let's pull out some of the money now, get this work done now, and then now we can sell your house for a lot more money. And that could be something that you do also.
As far as, is there any waiting period? So say if, sorry for Bailey in the backyard, that's killer. She's all of 7 pounds. So say I want to sell my home and I do a refinance in order to get the money to redo the kitchen. Is there any time frame, like by law in the finance world, that I would have to hold that mortgage before I can actually sell it?
So the answer is no, because we talked about the fact of like your 6 months of making mortgage payments before you refinance. But if you pull out money in order to rehab your house and then you want to go ahead and sell it later, for that, you're not going to have any penalties behind that, other than it's going to kind of depend on the structure of your loan. So told you before, we looked behind the curtain and looked at how loan officers and brokers are paid. Sometimes we take that money directly from the bank. We don't charge the consumer. And when we take that money from the bank, we're doing that with the notion that you'll have this loan on your books for 6 or 7 months. And if that's not going to happen, then it's your loan officer's job up front to say, hey, I can't put you into this particular loan because it's going to hurt me in the back end. We sell that loan off in less than 6 months, that bank is coming back to me and asking me for my money back. So I'm going to need to charge my consumer up front. And as long as that's done, now you can get rid of that loan day one.
Okay. Yeah. So Yoselin asked about, she said, can we discuss assumable mortgage?
Okay, so assumable mortgages, they're just exactly what it sounds like. Someone can assume your mortgage. Someone else can take your mortgage over. All right, so with an assumable mortgage, someone can take your mortgage over. The most common assumable mortgage is a VA loan, right? So the veteran, married or unmarried, gets the loan, and then someone, the veteran passes away, and there's an existing mortgage on that house. The veteran's spouse or survivor could assume that loan, to just take over making those payments using the same certificate of eligibility as the spouse or the survivor and assume that loan. There are very few assumable loans on the market as far as like conventional loans are concerned. Now, each lender does their own thing, and we call this lender overlays all the time. There are some loans out there where you can assume the existing mortgage when you come in to buy that house. So instead of needing to start over on a no 30-year term, you basically would come to terms with the buyer. on how much money they're actually going to walk away with. And then you're assuming the mortgage that they already have in place. And there's actually like ways to do that. There's a lot of creative ways to do that. So back in my days, I used to flip homes. I used to rehab homes, put them back on the market, and I would assume a lot of mortgage under my LLC. So we would come in and we would make the existing homeowner financially safe and secure to relocate. And then that LLC would just take over title on that property and assume that existing mortgage and start making those payments until that house was rehabbed and sold. That protected that existing buyer in many ways. We just assumed the payment. Most loans will say in the closing documentations, in fact, it even says it in the loan estimate, whether or not the loan is assumable. So it tells you up front whether or not someone else could assume that same loan. And what that does is it prevents the other person from needing to qualify and start that whole process. So there's already a loan. This person can make the payments. We can take over on. A lot of times you can get an assumable loan between family members. So let's say mom owns the house for a long period of time and wants to sell it to one of her children. Well, the child can, in preparation of this, get what's called vested interest in the home. And so let's say mom knows she wants to sell the house to the daughter. I would tell the client, hey, make the mortgage payments for the next 12 months. Let the daughter make those mortgage payments for the next 12 months. From the daughter's checking account or savings account, that payment goes directly from the daughter directly to the mortgage company. She now has vested interest, and we can try to get this loan in an assumable position. And the lenders will work with you when you can show that you have vested interest. I've been making the payments for the past 12 months. I'm buying this house from my parent. And it said, I just want to assume the same terms on this loan. And then Fannie Mae, Freddie Mac is really tight on that, but on a lot of the non-QM loan products, you can, in some cases, assume that mortgage and just basically take over the payments. And then for those ones, again, a lot of them are not assumable. It's on the loan estimate, tells you up front, tells you in the loan docs, no one can assume this loan. Anybody that wants to take over this house basically has to come back in with brand new financing. Some more reasons to refinance, similar to the one that we were speaking about with the looking at total outgoing expenses, monthly debt, those type of obligations, as opposed to looking at only the mortgage. I'm not a financial advisor, so I don't give that type of advice like tax advice, but there is some common sense in all that. You can write off interest for a portion of your home loan. A lot of that money is interest, especially in the beginning. And so the idea is, why would you write off the interest from your house, the mortgage, but then have this RV payment and these interest rate tied to all of your credit cards, and those things you cannot write off. If you have the equity in the home to just move all of that debt into the mortgage, you can now write off all of that interest, and you only have the one payment. And now you own those other assets. Right now you own that RV. It's no longer a liability. Now it's an asset because you own it outright. Mind you, if you ever go to sell that now, you're getting all of the money because you don't have a note tied to it anymore. And one of the misconceptions about refinancing is that you always have to start over on a 30-year term. You don't. There are a lot of banks out there that will allow you to, first of all, there's your straight 15-year fix. That's an option. But there's also 15-year, 20-year, 25-year loans. In fact, you can go down to an 8-year loan. So someone who's been in their house for 20 years and doesn't want to start over at the full 30 term, we can look at what the payments would be if we put you on an 8-year, 9-year, 10-year, 11-year. And these are all fixed rate loans. These are not 5-year adjustables that I'm talking about, or 10-year adjustable. These are fixed for the 5 years, fixed for the 10 years, fixed for whatever the period of time is, all the way out. And I think we go all the way down to about 8 years. So you can go from 8 to 40 years on mortgages these days. It's not just your straight 15 and 30. I kind of wrapped up on the assumable loan things, and it's a lot more user-friendly on the VA side and the non-QM side. And I'm trying to remember I have to do a little bit of research. I know I was reading something with an FHA loan recently, and I think that there's some leadway on an FHA loan being assumable between family members. But I'll look into that a little bit more. And then while you're gone, I just started talking about, reasons to group all of your assets, or excuse me, all of your liability and debt into your mortgage. How those benefits could play out for you financially with one payment and the tax benefits. You're actually muted right now.
I'm sorry. Look, the life of being live, huh?
It's okay.
Yeah, no, what I was saying is it could help out, especially if if you do kind of overextend yourself and you get to the place where you got a very high card note, or you got a lot of credit card bills, and when you can tie that all into one payment, like you said, I mean, you could save yourself some money.
Yep.
Just don't go back out there and do it again, but you can save yourself some money.
Yeah,
don't make
take
it a
all that
cycle.
cash flow just to go out there and take all that cash and put it somewhere else into more
Right.
debt. That's not the idea.
Yeah, that's
Now-
not the idea of it.
We did hint on this and talk about it, and I know that for a while we were focused on this as a marketing plan for real estate business. Is, once you've been a homeowner, what's the next step, right? Once you buy one property on the Monopoly board, what's the next step? Collect, you collect, and then you should go out and you should reinvest in yourself. And that's a huge benefit to owning a home that has any sort of equity, is you can pull that cash out and become an investor without overextending yourself. You can literally take the money out of your existing mortgage, cash out, refinance, use that money to help establish yourself as an investor. You go out and you buy something that you can turnkey, whether it's an Airbnb, short-term rental, 1 to 2 units, but you go out there and you use that as your down payment for the rental. And then if things go right, what you're doing is you're generating enough income there to pay that mortgage and that increase in your existing mortgage here, if there was one.
Right.
But you're gaining the equity as the homeowner now, or as the investor over here.
Break that down, because the first thing I could hear somebody saying in my ear, "Oh, I'm not putting my house up. Oh, I'm not gonna jeopardize where I live." So break that down, make it make sense for them. And how they are not jeopardizing where they live.
No, you're not leveraging your home. So you're not going to take your existing house and put it up as collateral for an investment property. And now you own an investment property and the tenant doesn't pay rent. And you're like, oh my God, I'm going to get foreclosed over here and they're going to take my home. No, they're not. All you're doing is taking cash out of your existing property and then doing whatever you want to with that money. The same way we talked about remodeling that kitchen. Maybe you want to add to the house, you want to put a pool in, whatever it is you want to do with your money, it's your money. So once you take the cash out of your existing property, does that change your mortgage payment on your existing property? Yeah, of course it does. It could be more money per month. It could be less, depending on how much money you pulled out, how much money you owe, and how much your existing property is worth. I have seen people pull out. I just gave you an example. The lady's mortgage went up, but she paid off a car and got 60 grand.
Right.
That's easily over $100,000 that she got. And her mortgage payment changed by $400. But actually, because of the savings from the car, she's saving money every single month.
Yeah.
And so if you could pull out $100,000 and your mortgage payment remains the same, why wouldn't you do that? Why wouldn't you
do it?
Why wouldn't you pull out that money?
Yeah.
Take that money and go and invest in a home that you could now put up as a rental.
Yep.
So your mortgage over here has nothing to do with the other mortgage.
Right. You're not going to lose your home.
You're not going to lose your home. And I don't want to,
unless you don't pay your mortgage.
And that's a whole nother issue.
Right.
Now, you can lose your investment property.
Yeah.
It's not going to affect your primary residence. Now, if you don't pay the mortgage on your primary residence, that's an issue.
That's
you got
the
to pay
issue.
your mortgage.
Yeah.
That you do have to do. And, just throwing it out there. There's so many ways to acquire property. So you pull off that $100,000, you can use it and just go straight to a home, right? And say, let me buy a house and get another mortgage. Okay, maybe not. Maybe you take that money and you go out to a tax lien auction. Now you got $100,000 in cash, and you have one of these auctions where you can buy a home for pennies on the dollar, either a regular foreclosure auction or a tax lien auction. So now you're acquiring property with the assets that you pulled out of your existing home, but now you own these things outright.
Right.
And that, there's so many ways to leverage your home. And let's just be honest. I mean, very few people buy a home, their first time home, and live in it forever. It does happen. It does happen. But most people, as first-time homeowners, they're buying a stepping stone. And I would just say, use it as a stepping stone then.
Yeah.
Gain you some equity, pay down principal. There's ways to pay down principal faster, right? So pay down your principal, get that equity, and then move into your next step home and rent out the older home. So now I'm going to refinance here, pull out some money. I'm going to use this to go buy me a bigger, better house for myself, but keep my other property as a rental. Even that's something that can be looked at. And while we're talking about refinances, I want to throw out this thing called, it's called an all-in-one loan.
Okay.
It's huge. There's so many benefits to an all-in-one loan, and I'm gonna see if I can pop something up here on my screen and share it if I can find it. But these are very popular in European countries and in Australia. Okay, an all-in-one loan is a loan product where your money goes towards the principal before it goes towards the interest. I'll repeat that. Your money on an all-in-one loan goes towards the principal reduction before it goes towards the interest. And that is where America has always been greedy in the way that we structure mortgages. American banks structure a mortgage to keep you in debt. For the first 30 years, or for the 30 years, for the first 5 to 7 years, that is interest top heavy. You're paying interest and very little principal reduction. An all-in-one loan is the exact opposite. You pay very little interest and money starts to reduce your principal from day one. We'll try to see if I can find this slide and share it, but I'm just going to explain it as we go. So the way that interest works is your home or your mortgage has a daily compounded interest. You're paying interest on your home loan every single day. You accumulate 30 days worth of interest, and then that's next month's payment. The 30 days in interest on your $400,000 balance plus, your $400,000 balance gets amortized with daily interest, and then that's your mortgage payment. And then there's a little piece of that will reduce your principal. And then next month, it's the same thing. You have 400,000, you reduce your principal balance by $200, you still owe 398,000. So for 30 days, they're calculating the interest on $398,000, $398,000 on day 2, $398,000 on day 3, day 4, $398,000 worth of interest, day 5. Every day they're calculating interest, they put it together, and then that's what you pay on day 30, right? So the next month, that's when your mortgage is due. You're paying 30 days interest balance that you carried last month. And an all-in-one loan, what you are doing is every single day, they will calculate your payment, calculate your interest based off of your bank account balance. I get excited talking about this sometimes with my clients. Let me first say, it's not for everybody.
Okay.
This is not for a 580 FICO score.
Okay.
This is not for someone who used 100% financing to get into this house. Okay. This is for your consumers that have good credit. Number one, have good credit. And number two, have pretty consistent and regular spending habits. Okay. And what I mean by that is they make good money, and every single month that money goes into their primary checking account. And then they've got most of their life set up on auto pay. and, they're just making their monthly payments as they go along. No big deal. And then at the end of the month, or, the first of next month, they write a check for their mortgage. Now, they are paying their bills on time, and everything is the norm for them, okay? This is a loan for them. So just imagine, and I'll explain it like this. I'm really trying to find this graph and I can't find it. So let's say that over the course of a month, you deposit $20,000, okay? Your loan balance is $400,000. That's what you owe on your loan. In your checking account, you have deposited 20 grand. Technically, your balance is only 380. You say, well, what does my bank account have to do with my mortgage? If you're in an all-in-one loan, it has everything to do with it. Because instead of calculating your principal balance based off of the actual principal balance of your loan, the daily interest, instead of calculating the daily interest off of the principal balance of your loan, the daily interest is calculated off of the principal balance of your loan minus whatever you've put into your checking account. So if you've put $20,000 into your checking account this month, then theoretically, they look at your principal balance as only being 380, and now you're paying interest on 380,000 instead of 400,000. Now, does that mean they're going to keep my 20 grand? Nope.
No,
not at all. Because again, with your regular spending habits, you will take money out of that account to pay your credit cards. You'll take money out of that account to pay for all of your regular expenses. And then after they've calculated your interest, now you'll make your mortgage payment the same way you would have anyways. But in theory, because it's the all-in-one loan, you're paying way less interest because it is being deducted. Every time you make a deposit, they deduct that from your principal balance and then calculate your interest. Every time you make a deposit, they subtract that from your principal balance and then calculate your interest. And if you can just wrap your head around how that works, you will understand like the major benefit. Let me see, I found a video. Let me look at this and see if it's got the slide in there.
and then I have a question while you're looking. So what would be, I mean, I know a couple people that make 20 grand a month. What would be the downside to something like that?
I hate to say this because people will be like, oh, can you hear that? Let me cancel that. I don't know if you can hear it, but it's loud on my end. Hold on one second. Okay, let me see. There is no downside.
Okay.
There just is no downside because you have 24-hour access to that money anyways. So there just is no downside. All right, so I want to share this. Can I share?
Yeah.
My screen?
Let's see. Jason, can you make? Okay.
Let's see. I think I'm sharing it. Can you see it?
Yep. We see
Awesome.
it. Okay.
There's your regular 30-year mortgage right there.
Okay.
So all that gray is how much interest is going towards your home loan. The green is the principal, right? So like in your last couple payments, you see over here, like now you're paying very little interest. And then all of that month's mortgage payment is going towards your principal. The problem is, and as this has been the same way for years, most people tend to refinance in the first 3 to 5 years anyways. And so you're refinancing in this period of time when you've barely reduced your principal.
Right.
Okay. Now, let me just see if this shows the other portion of the flip side to that. It doesn't. All right, I'll find that other slide and show you the difference.
Okay.
Yeah. This kind of starts to show it. That kind of shows it, but there's actually a chart like the other one.
Okay.
So as you make your payment, it pays down equity. You see the white part is the equity dollars gaining, gaining, and gaining, and gaining. You could literally deposit, you have a $300,000 balance, you can deposit $300,000 into the bank over 6 months, your house is paid off. It won't close the loan because you can still pull from that money to handle all of your monthly expenses, et cetera, et cetera. But I'll have to share the slide and I'll post it back to this stream or to this this post later so people can go back in there and see the slides to really understand what it is I'm talking about. But at the end of the day, it's this in reverse. That's at the end of the day, it's this in reverse. The money that you pay goes towards principal first, and then the interest. Why is the interest so low? Because you've been depositing money, and the way that this thing is figured out again is you take your principal balance, you subtract or give credit to all of your deposits that you've made all month long. And so if your principal balance is 400, you deposited 20 grand, you're at 380. Your interest is based off of the 380, not the $400,000. And that resets itself every single month as you do that. And what happens is in the first 5 to 7 years, you have 60 to 70% equity in your home.
Wow.
And people tend to pay this loan off. This is not a loan where you need to remind yourself to make payments. This is not one of those loans where you have to think to yourself, oh, if I double up on my payment, I'll own my home quicker. This is built off of your regular spending habits, and it just pays itself down faster. And for those individuals that see their principal reduction go down so fast, so quick, and they're like, well, can I close my loan? Because it says I have a zero balance. You can actually close the loan and you own the house. Or you can leave it open and treat it as an equity line now and just basically, let's say, buy a house, go buy an investment property. So now you pull out 150, you buy the investment property, and now you're just making payments on the 150 you pulled out of your own checking account. And the difference here is the bank is treating your mortgage as your investment as opposed to the bank's investment. Because what is the bank doing with our money anyways? They're flipping it. They're making money off of it the whole time. And so this is just giving you, the consumer, the opportunity to do the exact same thing, if that makes sense. So, okay, sorry.
I like that.
The downside.
Look, but let me ask you.
Sure.
Let me ask you something about the all-in-one. Okay, so you said this is for people that credit score is, they pay their bills on time. Their credit score is good. Yeah. So they got probably about a good, what,
700 FICO.
Okay, 700 FICO.
Score.
Okay. And they're not overextended.
Correct.
Meaning they don't have a lot of debt.
Correct. You can have some debt. You don't need to be debt free.
Right.
But your debt to income ratio, we talked about this before, 50% up to 56 and some change on an FHA loan, 60% on a veteran's loan, all in one, you're going to need to be 45%.
Okay. 45%. Okay. And then as far as monthly income, where would they be? Could they be at 5,000? Could they be at 10,000 a month with and is this combined income? Like, is this husband and wife or yes, partners? Like, what does that look like?
So income is always counted as everyone on the application. So we're going to go off of the minimum score between the two borrowers though. So not the minimum score, but the minimum between the two. So, let's start at the basics. People caught on already. We run 3 credit bureaus. Your middle score is your qualifying score. So this person's qualifying score and this person's qualifying score, whichever one is lower, that's the one we're using. That needs to be the 700. Income is everybody's income and everybody's debt, right? We can't be like, I'm gonna count my money, but not my debt. We count your money and your debt. If that housing expense, the housing expense is the new mortgage payment plus taxes and insurance. If that housing expense is 45% or less, you qualify for this particular loan. You don't have to have there's no minimum income guideline. You don't have to make at least 7,000 or at least anything. You just have to make enough to where your debt to income ratio comes out to that 45% or less. If you have that sort of DTI, and you've got that 700 FICO, then this loan is something that you can look at because it allows you to pay down principal at an accelerated rate, but always have access to the equity. And that's what the all-in-one loan is. Because people can say, well, can I just pay more money towards my mortgage anyways? You can, but can you get it back when you want it? You cannot.
Right.
Now, without doing a refinance,
Mhm.
so this is a loan that allows you to make more payments if you want to, but regardless of the rate of equity that you put into your home or the principal reduction that you put into your home, you have 24-hour access to that money. You can
Now, is this
always
a day
write a check
one?
against it.
Is this a day one? Like if they could you get this day one of you purchasing a home, or
You
is
can
this
actually
a
purchase with an
refinance?
all-in-one also. Yes.
Wow,
You can
okay.
purchase loan all in one. It's, loans are instruments. Loans are just an instrument of lending. You can purchase with this loan also. So, you know about reverse mortgages, right? What a reverse
Right.
mortgage is? You can purchase with a reverse mortgage. People don't know that. So you can go into a house with a bunch of equity, put your money into the house now, and then treat it as a reverse mortgage and let that money flow back to you the whole time. A lot of people older in age, fixed incomes, they take all their, we sold our dream home and now we're going to downsize and I'm giving up all this cash. Now I'm stuck with my fixed income. No, you give up all that cash, but purchase with a reverse mortgage. And from day one, start pulling money back out of the house, having that money sit back to you. That's something too. So the all-in-one loan can be used as a purchase. It can be used as a refinance rate in term. So again, I'm not taking any cash out. I'm just refinancing the principal balance. And it can also be used as a cash out refinance. So I want $60,000 in my hand at close, and I want that loan also. And that's all those are on the table for the all-in-one loan.
I like that. I really like that all in one loan.
It's been around forever. I got
Yeah.
into the market in 2005. I wrote my first home loan either in 2004 or 2005. This product was around then. It was around so long that someone else, one of the other big banks, bought and trademarked the name as Equity Accelerator or something like that. It was called the Equity Accelerator. And so then they started branding it as that as they sold it out to clients. And then the person who invented it just changed the name, right? They sold off that trademark and rebranded it as the all-in-one loan. There's more than one institution that does it. Several different banks do it, but it's always, how come I don't know about this? Because the bank ain't making no money off of it.
Right. What
That's
about
why.
the interest rate on something like that? Is the interest rate any higher on that versus your?
These rates, so this is not a 30-year fixed loan. There's your one, I knew there was a catch. But let's start looking at fixed rate loans compared to adjustable rate loans. I've shown you that graph before.
Right.
Adjustable rate loans are always lower than fixed rate loans. So is your rate going to fluctuate? It is. It's tied to, there's no more LIBOR. LIBOR used to be the big thing back in the days. LIBOR's gone. Now they use the SOFR. And so it's tied to a rate that's basically tied to prime, which all the hoopla says in May, we're going to get a reduction on the prime rate. Whether it comes or not, who cares? But it's tied to prime, and fixed rates are higher than prime. So it's tied to prime, but fixed rates are higher than prime. Yeah, you can only take the horse to the water so many times.
You can't.
Yeah, so it's an awesome loan. It gives you all this affordability, but at the end of the day, what's happening is your principal reduction is being paid down at an accelerated rate to where you can own your home much sooner, close the loan and just cash flow yourself, right? Or if you're pulling all that money back out. So here we go. Let's say I am putting $20,000 every single month into my checking account, but I spend it all. That's fine. Because when we calculated your interest, it was still calculated off of what was in there at the time, as opposed to the $400,000 principal balance. So even in that scenario, you're saving. Now, the object is you're not spending the whole $20,000 every single month.
Right.
And so whatever you're leaving behind in your bank account, that is treated as true principal reduction, and it sits there, major principal balance lower. Come back in there next month, you do the same thing. You say, well, isn't that just a savings account? It is. So imagine if you had a really fat savings account. Technically, your home could be paid off, or at least the daily interest that you're paying would be phenomenally less, and you'd pay off your house much sooner.
Wow. That's good stuff, Antonio.
It is.
I love the fact that you're coming with things that in our community, you really don't, certain things are unheard of. In other communities too, and I think that's what hurts us is the things that we don't know. Yeah. And we think that it's just this option only, and it's not other options when it comes to financing and growing your what can I say? What am I trying to say? Your net worth, your net worth, I'm sorry, as well as, making sure that you are trying to leave a foundation and a legacy for your children or whoever you might have. And that's how we do it. So,
and just real quick, this one is huge in Europe and in Australia and other countries. And so if you have a family member that's from one of these other countries, ask them about this particular type of loan. People in other countries pay off their homes in under 20 years on a regular basis. And it's not because they're making extra mortgage payments. It's because the mortgage banking system is different outside of America.
Yeah. Wow. And now, is there any states or anywhere that these mortgages you can't do? Or is it across the board? If you qualify for it, then you probably could do it.
That's a great question. And off the top of my head, I feel like it's not eligible in New York.
Okay.
I feel like I'm gonna write a note here because I want to put these sides back into this thread, and I'm gonna check on the eligible state. And I'll post that there too. For some reason, I feel like it's not eligible in New York, but I could be wrong.
Okay.
But I'll jump back in here and update the thread, and people can see it there.
Okay, sounds good. Well, I so appreciate it. Appreciate everything that you're bringing to us. I know we are going to be changing. I'm sorry, go ahead.
I was just saying, glad we have these talks.
Yeah, absolutely. I know we're going to be changing our day. So we're going from Mondays to Thursdays, same time. So, I just look forward to talking to you next Thursday and just learning more and educating more people about loans and mortgages and, all this good stuff.
And next week we're going to talk about mortgage rates.
Yep. Sounds good. The thing everybody is scared of.
All righty. Well, it's been a pleasure. I'll see you next week.
All right. Let me go look at my new refrigerator.
All right. Take care.
All right. Bye-bye.
Bye-bye.